Hi everyone, it's Chris here from Serene Education. Going to be doing the 4 majors analysis update for the forthcoming week, and it is the week ending August to the first week of September. So we're looking at the 30th of August right through to the 4th of September 2015. 4 majors, let's have a look at the euro. Let's look at the last week to see how last week ended, just to give us an idea what we should be looking for the forthcoming week. So you can clearly see that we've seen over the last month or so movement to the upside. However, that's been hindered by the highs that we saw back in May of 2015, and not the first time but also the second time. So we had multiple resistance levels at the current level here that price tested this week. In fact, we actually saw the euro climb even higher through this week, through the 50 period moving average, in fact, on the weekly. But having said that, by the end of the week we saw bearish sentiment coming back in again. So what we're actually looking at here is potentially an exhaustion candle. So you can clearly see he had 1145 and change, a clear resistance level through most of 2015. In fact, we are currently above the 20 period moving average. However, if you look at the template for the FX8, you'll notice that the candlesticks throughout this consolidation have remained red. Okay, so we do have a blue arrow down the bottom here. However, looking at the overall candlesticks, we have been in a consolidation, and we haven't seen any new highs, especially new highs created at the start of this year, back in the April of 2015. Not seen price actually closing higher than that level. So ideally, if we are to see any genuine long-term bullishness for euro against US dollar, we would need to see the current 2015 resistance level high, which is at 1145, being broken or closed higher than, to then give us more emphasis of a deeper pullback of this overall consolidation. That's failed to materialize, as we've seen price closing lower yet again. So if you look at the overall indicator box over here, you can see it's starting to look a bit speckled. The overall long-term sentiment on the monthly is still looking negative. Having said that, you'll see that the weekly time frame, we're seeing a lot more positive coming through. So on a weekly time frame, we're starting to see a bit more bullish sentiment coming through, and we did see that bullish sentiment coming through for the prior week. Having said that, not seen a close high. So looking at the new month of September, ideally what we would want to see, if we are to see any further euro positiveness against the US dollar, we would need to see a weekly candle closing higher than the current resistance level here at 1145. So looking at the objective for this week, the following week, the new week of September, in fact, we would need to see a daily bullish close higher and then a continuation to the upside. So I'm just going to go ahead and put on the monthly pivots quickly. There you go, and you can clearly see, if I just pan in, you can see the monthly pivot for August is still below price, which is a positive sign, so we should be looking for upside. You can see the 20 period moving average is below price, supporting us, so we should still, there again, positive sign. However, saying that, we don't have the 50 period and the institution moving average, which is the most important one. The institution, the 200 period moving average, is still very much above price, so we still very much in a negative trend. But you can see that we're not trending at the moment now, we're actually consolidating. So we're moving sideways, and ideally we want to be moving out of this consolidation to see a recontinuation of the negative trend or a start of a new trend, and that's where we need to look for new highs. You can clearly see here on the monthly R2 level, if I bring this one to that level over there, you can clearly see being a resistance of price. So there we go, the monthly R2 is where I drew my horizontal red line before, and you can clearly see where it has dissected the actual, intervened where price is trading right now. So vitally important. If we drop down to the daily now, there we go, we need to see price trading above this level over here. So on the daily now, you can see on the daily there's a lot more positive sentiment coming through, but the parabolic SAR is not in our favor. Having said that, everything else is very much in our favor. You can see the aggressiveness of what we saw this week. We saw a lot of positiveness the prior week, but looking at the last couple days on last week's close, you can see a very, very strong pullback indeed. An evening star, these three candlesticks over here pointing on an evening star formation, and you can see Thursday and Friday really selling off to the monthly level. Notice, however, on the daily we'll also have the institution moving average below price now, and if I just pan out here, you can see that we haven't been above the institution moving average for quite some time. The last time we were above the institution was all the way back in May of 2014. So psychologically, we've seen price breaking the 200 period moving average. Having said that, we also saw it breaking the current 2015 resistance level high, which was here at 114, as I mentioned to you. But unfortunately, not being able to actually hold on to those levels. So we saw the breakout. You'd expect a pullback, but the pullback failed to actually hold those highs above here at that 1145, as I mentioned. We need to get above those levels again. It's still above the institution, having said that. So a breaker pullback, a deeper pullback, but it's still within this consolidative range. So the institution is still on the smaller time frames, actually holding that line, that supportive line. But if we are to look for any further genuine US dollar, euro against US dollar strength, we would need to see the current resistance level higher being broken before we see a continuation. Failure to do so, we're trading back within a range, and trading back within a range brings brings more risk to it because of the volatility within that range. So here again, entirely your choice to see how that. Remember, it's the start of a new month, so therefore you could expect non-farm payroll this Friday coming, and yes, indeed, we do have it. They're expecting actually a positive non-farm payroll figure, a slight increase compared to the prior figure. The prior figure was 215,000. They're expecting 220, so only a 5,000 difference. However, saying that is still positive. If that was to come out as expected, we could see further euro negativity. Okay, if that figure is negative indeed, then we could see that euro bounce. So look to those figures to see if there's any help with the non-farm payroll. Let's move on to sterling. Here again, looking at the hard right edge, you can clearly see that we've seen a very bearish week last week. In fact, this bearish candle here, this candlestick movement has actually engulfed. And when I say engulfed, I'll show you. It's engulfed all of the prior data before it. You can see 1, 2, 3, 4, 5, 6, 7, almost 8 full weeks of sideways motion. Price last week has actually engulfed all of that. So a lot of negative sentiment coming in for sterling. And in doing so, the sellers have clearly now taken price lower. It's taken price lower than the 50 and the 20 period moving average, and is still being capped by the institution moving average. Clearly seen that. So that's the high of 2015 here in June of this year. Clearly price at the institution has failed yet again to break that level. And similar to its European counterpart, if we'd seen the institution being broken, we could have expected a further pullback. So negativity coming back into the market again, and in doing so falling lower, and in doing so forming a bearish engulfing candlestick at a major resistance level, which happens to be the institution moving average. Therefore, we should be looking for negative sentiment going into the start of September for sterling against US dollar. Here again, non-farm payroll could very much be the undoing of sterling this week. But have a look at the other data that's likely to come out this week, just to see if there's anything over there that could actually put further negativity on sterling and put more positive on US dollar to give us that breakout continuation to the downside. We do have a number of targets. We have the target that we had recently here in early the end of May going to June, not too far off, but the most important one would be the lows that we saw way back here in early May, April of 2015. And between those 2 points, there's enough money to be made, almost 650 odd pips. But let's draw our monthly pivots on there just to give us a more defined indication of where price is likely to go to. There you have it. You can see the monthly pivot is above price. Okay, the weekly candle is closed low. There's a monthly pivot. It's above price, so that's a negative sign. All our moving averages are 20, are 50, and in the institution are above price. There again, another negative sign. The candlesticks are negative. The only thing that is missing from here is the red arrow. We only have a blue arrow, which was way back here in April of this year. But the only thing that's missing is the red arrow. Notice that price is actually closed at the monthly S1 level, which happens to be a price support and resistance level in its own right here at 15390. Monday, Tuesday, Wednesday, Thursday, Friday of the new week, next week, Tuesday, Tuesday, Wednesday, Thursday, Friday, because the bank holiday on Monday, we do see a closed low. We could look to target the S2 level. But remember, Tuesday is going to be September the 1st, so therefore we want to have to draw all these monthly pivots again, and they might have changed slightly because of this month's data, i.e. August month's data. That will all be directed. So you can see clearly here we are seeing some genuine target levels to the downside. and the all important one will be this level down here, but you can clearly see there are genuine targets to the downside. So here again on sterling against US dollar, look for sterling negativity and US dollar strength to continue pushing this lower to see an opportunity. The other upside would be if we see sterling strength and US dollar negativity, then we could see price moving back within this range. And if you drop down to the daily, you can see that price has been in a very messy range for, as I mentioned to you, almost 2 months now. So look at the institution moving average on the daily. It's still below price supporting her. So vitally important, we would need to see Tuesday, Wednesday, Thursday, Friday of the following week, September week, closing lower to then give us a genuine selling opportunity to the levels mentioned below. Notice the actual box. There seems to be a lot more negativity on here, a lot more red than blue. Therefore concurring with what we're seeing on the chart at the moment now. So vitally important, look for the confirmation break low and then trade to these levels to the downside. Remember, monthly pivots will change again because on Tuesday we're going to have to redraw them again because September starts on the Tuesday, the 1st of September. Okay, just remember that. Let's move on to the US dollar Swiss franc. Here again, notice the indicator box, predominantly blue. We've seen a lot of whippiness through the start of 2015. In fact, you can see the highs over here in December, January, and the lows that we saw in January after all that negativity that came through after the Swiss National Bank unpegged its currency against the US dollar and the euro. And we saw, however, price making all that back, but you can still see that price is not making any news, has not attempted the prior high, the January high. We've seen the US dollar losing a bit of strength as the months have progressed for 2015. In fact, having said that, still managing to maintain that level above the institution moving average. Vitally important. As long as it stays above the institution moving average, then we should still be looking for bullish bias. Okay, and seeing that, you can see the last 2 weeks, in fact, falling low again after this bearish Arami. There we go, bearish Arami formation. So bullishness, and then we saw no new highs and price actually putting all the way back to the lows, forming a bearish Harami, and vitally that's led to further selling the past week, and then last week we actually saw consolidation. But you'll notice that we're still within the range, not a really good range, quite a messy range. In fact, if I drop down to the daily, you can see that huge fall and then a correction. So a lot of volatility in the market the last week after a lot of negativity came out because of the growing uncertainty in China, major concern in China afterwards. And you don't have to look at what's written on the websites out there just to have an idea of how severe it was. But you'll notice that price has actually been able to pull back over the last 3 days. In fact, we saw an inverted hammer here, for example, and then we see nothing but upside for the US dollar against the Swiss franc. So here again, mixed results. The overall bias on here is positive, so we should be looking for buying sentiment. But if you look at it, the risk goes up because of the volatility within this particular chart. You can see on the daily we had a nice little trend to the upside within the range, mind you, but then we saw a break of that, and we've seen prices falling. So for me personally, I don't like trading this particular pair because it's in a very messy range. Entirely your choice. If you are looking to trade this, then you might be more profitable if you're trading aggressive intraday time frames. For me, it's one that I've actually stood away from and looked elsewhere. So here again, entirely your choice. Remember the risk involved trading within a deep range, and yeah, let's leave it at that. Last pair of the day, US dollar Japanese yen. Looking at the current status on this particular pair, you can see that when we went into 2015, we had an attempt here in March, April of 2015 of the high that we saw in November, December of 2014. Then we saw a break high. However, saying that, you can see that price has done nothing since. This is May, June of 2015. You can see price has been very, very indecisive. A lot of indecision creeping into this particular pair and moving sideways. If you're looking to trade the US dollar Japanese yen, I don't know how you made your money in there. The risk would have been through the roof. But you'll notice that last week we saw a lot of selling for the US dollar. Having said that, by the end of last week, we saw US dollar strength coming back in again, and it's led to this very, very, very indecisive long wick. Okay, so but you'll notice for the first time, however, price has now dropped below the 20-period moving average, and some pairs actually use the moving averages as very strong support and resistance levels. You'll notice that on this particular pair, the 20-period moving average has acted as a very strong supporter price. So psychologically, if price is trading below that level for the first time in as many months, then psychologically it could be telling us a story. Notice the actual candlesticks are still positive, but we've seen a lot of resistance above price, a lot of hesitation of the US dollar to gain further upside, which we've seen over the last couple of years, to gain further upside against the yen. That's failed to materialize over the last 2 months, in fact, and we saw a bearish engulfing candle the prior week. Last week we saw selling on the back end of that because it actually closed lower than the 20-period moving average. So last week, in fact, we should have been looking for potential selling opportunities, aggressive selling opportunities, daily or intraday, to at least the 50-period moving average as our first target, and which would have been the low that we saw in 2015. And you can see that price actually moved to those levels. So I'm just going to go ahead and apply the monthly pivots to this to give us a more defining aspect of what price is likely to do if we do get some. But remember here again, as I mentioned in the last two, we should be redrawing our monthly pivot come Tuesday because of the fact that it'll be the first week of a new month, and the monthly pivot will have to be redrawn. Okay, so let me just apply that. There you have it. So now you can see the monthly pivot above price, which is a negative sign. You can see we have a bearish engulfing candle, which is a negative sign. It's trading below that level. It's trading below the 20-period moving average, which is the candle before. Remember, we're looking at the weekly time frame. Yeah, we have a red arrow. The candlesticks are still positive though. Notice the RMO is clearly still above the zero level. But having said that, as we've moved through 2015, the MACD or the OSMA has been predominantly negative. So telling us there's a clear slowdown in this upside trend. Remember, you can see if I just pan out, you can see we've been in a very aggressive positive trend over the years. So it started here in 2011, picked up steam through 2012, 2013, 2014, a lot of growth through 2013, 2014, and heading into 2015, we started to see a bit more hesitation, a crossover. So we're seeing a bit of hesitation in the trend, slowdown in trend direction, as we've seen the US dollar gaining a less strength against the yen over the last couple months, in fact. And we saw a lot of driving low again. This is purely to do with the uncertainty within the Chinese market. We cannot afford to have a weak Chinese market because that will impact the entire globe in some degree. We rely heavily on Chinese market, both for production and for them to be buying our goods. So there's a give and take, and at the moment now, if China slows down, they won't be buying as many goods from the Western countries, and vice versa. We won't be buying any from them because of the slowdown. It all goes hand in hand. So look at the macroeconomics. So here again, you can see that price is clearly still holding on to that monthly pivot, which happens to be the support and resistance level high that we saw, as I mentioned, when I first started, the high in 2014 and the current resistance level high in early 2015 that we broke. So price is hanging on to that level. What we could see, what we're looking to see if the candlesticks are still positive, is to see bullish sentiment. Okay, the overall bias of here is predominantly positive, especially the monthly. You can see a lot of negativity creeping into the weekly and the daily, but you can see a bit of positive coming into those shorter time frames as we saw bulls coming back into the market again towards the end of the week, the last week in fact. So what we want to see now, if this is to be a genuine positive sign, then we need to see bullish sentiment going through Tuesday, Wednesday, Thursday, Friday. As I mentioned to you, this is the US dollar against the Japanese yen. So non-farm payroll comes out at the end of this week, this forthcoming week. If the figures do stack up and they do come out as strong as expected, we should expect US dollar strength against the yen. Okay. The other side is we continue to see negativity coming out for the US dollar as this week, the new week of September, unfolds. Then we could see further negativity taking us back below this monthly pivot level here, which is the monthly S1 level, and then we could look towards the 50-period moving average again, because we've targeted it once already last week. We could see price heading back to that level again, and between that 2 points, you're looking in excess of 240 odd pips. You're not going to get all of it, but there's more than enough on there to make a decent return. So vitally important, we've got to see either a building candle, because prices actually saw a lot of buying, but the concern remains that we saw a lot of selling beforehand. So that's still going to be there. So got to be vitally important. If we are to see this to be a support, then we need to see a building candle. We need a bullish engulfing candle on a daily to confirm that bullish upside. The other scenarios, if this is to be genuine selling over here, then we need to say bearish engulfing candle coming out on Tuesday, Wednesday, Thursday, Friday to give us that continuation of selling, and then we know where our targets are. So vitally important, be patient, wait for price to dictate direction, and then we trade the outcome. Vitally important. All we do then is we just back it up with sound money management rules. Vitally important here again, got to apply solid money management rules to any trade that you're doing. And that's it. I'm going to leave you with that. I hope you have a fantastic start to September of 2015. Keep it simple, guys, and most importantly, trade serenely.